Hey, what's up guys? John here. It's happening. The Fed just increased interest rates 50 basis points as I predicted this morning. They are now in the process of reducing their $9 trillion balance sheet starting June 1. So in less than a month, they're going to be reducing this balance sheet. And they are now also considering that the markets now expect the central bank to continue raising rates aggressively in the coming months with possible 75 basis point hike on the table for June. Wednesday rate hike will push the federal funds rate to 0.75 to 1%, and current market pricing has the rate rising to 3 or 3.25% by year end. Wednesday's statement noted that the economic activity edged down in the first quarter, but noted that household spending and business fixed investment remained strong. In response to what's happening in China, they believe that the supply chain disruptions are likely going to continue. As the pandemic crisis hit in the early 2020, the Fed slashes benchmark funds rate to a range of 0 to 0.25 and instituted an aggressive program of bond buying, then more than doubled its balance sheet to some $9 trillion. At the same time, Congress approved a series of bills that injected more than $5 trillion in fiscal spending into the economy. Those policy moves come at a time when supply chains clogged and demand surged. Inflation over a 12-month period came in at 8.5% is what they say, but many people, if you go to the shopping store, you go grocery shopping, you spend money anywhere, you know it's not 8.5%, not for what we buy. It's probably 30 to 35%, maybe 25%, in that range. It is a very, very big discrepancy between what they say at 8.5% versus what actually happens when you get to the cash register and check out. For the first time in more than 3 years, the FOMC in March approved a 25 basis point increase, indicating that the then funds rate could rise to just 1.9% this year. Since then, though, multiple statements from central bankers pointed to a rate well north of that. Wednesday's move marked the first time the Fed has boosted rates at consecutive meetings since June of 2006, right before the big crash. Stocks have tumbled through the year, the Dow Jones Industrial Average off 9%, and bond prices falling sharply as well. The benchmark 10-year Treasury, which moves opposite price, was around 3% Wednesday, a level it hasn't seen since late 2018. What I believe is very likely to happen is I think retirees, people 50, 55, 60 or older, people that are entering that retiree phase are going to say, hey, does it make sense for me to bet my money in the stock market, in the markets today, knowing what I know now? A lot of people are going to, I think, be a little bit more defensive. I think people are going to really weigh the risk more than they weigh the potential upside reward and really play this from a place that hasn't been played in the last couple of years, where we've really seen a market of extreme speculation. Many people have made a lot of money, but it looks like very soon people are going to lose a lot of money. What do you think is going to happen? Drop your comments below, hit the like button, subscribe here, also on my second channel. I'll leave the links all down below. Catch you guys later.